மார்க்கெட்டோட நிலவரம் மேல போகும் கீழே வரும். இந்த ட்ரெண்ட் எல்லாம் பார்த்து ஆசைப்படாதீங்க. கொஞ்சம் கொஞ்சமா நீங்க பண்ணுங்க இன்வெஸ்ட். கனவு எல்லாம் நினைவாக்குங்க, இதுதான் பெஸ்ட். ஸ்மார்ட் மற்றும் சிம்பிள் பிலாசபி. ஸ்மார்ட் மக்களுக்கு இதுதான் ஐடென்டிட்டி. டெஸ்ட் பண்ணு நீ, ஸ்டார்ட் பண்ணு நீ. சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான்ஸ் அண்ணா சொல்றத கேளுங்க. அண்ணா ஸ்மார்ட் ஆகுங்க. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. பண்ணணுமா 350cc சவாரி, இல்ல செகண்ட் ஹனிமூன்ல ஆப்பிரிக்கன் சஃபாரி. கட்டணுமா ட்ரீம் ஹோம் இன் டவுன் பேமெண்ட், இல்ல செக்யூர் பண்ணணுமா ராக்கிங் ரிட்டையர்மெண்ட். பிளான் பண்ணணுமா உங்க ஃபாரின் ட்ரிப். நான் செய்ய வேண்டியது ஸ்டார்ட் சிப். ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயங்களுக்கு உட்பட்டவை. முதலீடு செய்யும் முன்பு திட்டம் சார்ந்த ஆவணங்களை கவனமாக படிக்கவும்.
Carefully.
Hello and welcome to Smart Investor, an investment education webinar brought to you by ICICI Prudential Mutual Fund and the Hindu BusinessLine. Through these webinars, our endeavor is to impart knowledge to mutual fund investors that helps them make the right investment decisions. The topic for this webinar is investment strategies for retail investors, the do's and the don'ts. To quote the Nobel laureate and American economist Paul Samuelson, investing should be dull. It shouldn't be exciting. Investing should be more like watching paint dry or the grass grow. If you want excitement, take $800 and go to Las Vegas. But as we all know, this is really hard to practice. So we will be discussing these foibles and much more over the next 1 hour or so with our experts. In the first part of the webinar, Mr. S. Harish, Zonal Head South ICICI Prudential Mutual Fund, will be making a presentation on the strategies that mutual fund investors can use in this market. In the second part, I'll be having a conversation with the market maven, Mr. Bharat Shah. Following this, in the last part of the webinar, we'll be taking questions from the audience. So if you have any questions, please do type it in the Q&A box below, and we'll try to take as many as possible towards the end. So I now request Mr. S. Harish to take us through his presentation. Mr. Harish, in a career spanning about 18 years in banking and financial services industry, has worked with various mutual funds, including the Kotak and the Reliance Mutual Fund. So we are waiting to hear from you, Mr. Harish. Please take over.
Yeah, sure. Thank you and a warm welcome from ICICI Prudential Mutual Fund. In about 20 minutes, I'll just try to give a simple strategies what as a customer, someone can just look at it from the mutual fund angle. This is a structure of the mutual fund, very basic. Investor put in money into the mutual fund scheme managed by a fund manager. And again, the returns comes in, it's been returned back to the investor. If you just look at the structure of the mutual fund, this is the structure of the mutual fund. Basically, there is a sponsor, trustee. Sponsor appoints a trustee. In turn, they appoint the mutual fund. There is a transfer agent, custodian, and AMC. So an entire structure is being governed by SEBI. So, with respect to transparency, if you just look at it globally at this point in time, Indian mutual fund industry is one of the very, very transparent industry. And if you just look at the 6 strategies while investing in mutual fund, first is about rupee cost averaging as a theme. How this rupee cost averaging can be done? It can be done through systematic investment plan and systematic transfer plan. I'll just give a glimpse in the next slides. What is it and how we can just use this? Next is about investment into debt mutual funds. Then auto rebalancing of portfolio through dynamic asset allocation funds and making a core and non-core portfolio. Then through mutual fund investments, you can just get your entire financial planning also done. And finally, the very important thing is about what is the investor behavior. These are the 6 pointers which I have. I'll just run it past through you. First is the rupee cost averaging. You have seen a small ad on a SIP, systematic investment plan, over a period of time. Okay, if someone enters the market very, very periodically, the risk is getting mitigated. Your rupee cost averaging is relatively better. What is this rupee cost averaging? Simple. You go and buy a stock or a mutual fund scheme. So, for example, at 100 rupees today, and next month the same 100 rupees is getting invested. The third month again the same 100 rupees is getting invested. But you're just getting the mutual fund units in a different NAVs. So your first time your NAV can be 10 rupees. First month, second month can be 8 rupees. Third month can be 9 rupees. So that your average cost is intact. So this is how the rupee cost averaging works. Second is the systematic transfer plan. And third is about the systematic withdrawal plan. I have a slide for this. We just look at this. How does this SIP works? The money goes from the bank account to the respective scheme. It can be equity fund or a debt fund, whatever the scheme you choose. Second is a systematic transfer plan. Here also what we advise for the normal customers, especially for the retail customers, is to choose for a systematic transfer plan, because they might not know which scheme to choose, because so many schemes are there, so many themes are there, which one to choose. Better to mitigate the risk, we advise people to put the money into a debt mutual fund. From there, a systematic transfer plan can be done towards the equity scheme. No, there are daily STPs available, there are weekly STPs, monthly STP, all the different options are there. The money can move from debt mutual fund to equity mutual fund over a period of time, so that going as putting a lump sum money even at the peak of the market, those mistakes can be avoided. And third is about the systematic withdrawal plan. This basically can be used for especially the retired people who wanted to have a regular income. So build a corpus, put the money into a debt or a hybrid fund. From there, if you're just going to opt for a systematic withdrawal plan, automatically a fixed amount will get withdrawn from the mutual fund scheme and just goes back to the bank account of the customer. So these are the three things which will really help you for a periodic investments as well as a rupee cost averaging as a concept. Then why investors should choose an SIP and STP is purely because of these four factors. uh, Ignorance to the power of compounding, because a lot of people, what they do, they just will not wait for the market. They'll not give that investment time frame on what basis they're just investing into the markets. So what they do, once they see a specific uptick in the market or a downside in the market, they just go and take the money out of the market. So what we recommend is, if you want to actually enjoy the power of compounding, okay, then you need to choose an SIP or STP, so that the because of rupee cost averaging, that helps the power of compounding also. Second is about, you can just get your entire financial planning done. Third is about your delay cost can be mitigated. So a lot of people might be sitting on the silence of the market, stating that the markets will correct, let me invest. When the market goes up, no, I'll just pull out the money. No one will be able to time the market. So this SIP and STP really helps a retail customer in a big way. And fourth is about the rupee cost averaging, which I already spoke. What we'll do is, we'll just do a small poll now. Okay, there will be a question which will be there in your screen. You can just answer those questions. The question is, what is the eighth wonder of the world in financial terms? Is a question. You can just answer that question. Then we can just move on to the next. So actually, this is the next. Yeah, the eighth wonder of the world is actually the compound interest. Compound interest is the uh, eighth wonder of the, yeah, 75% of them has answered right. Yeah, good. So power of compounding is the compound interest. Power of compounding is the eighth wonder of the world. So I'm just going to give a small. Yeah, just see a small illustration, very important illustration, because we could have seen this kind of different type of returns over a period of time in a lot of Excel sheets, spreadsheets, and so on. But if you just minutely just look at it, what the difference it makes over a period of time. So this example is all about a 10,000 rupee investment into SIP over a period of 5 years, 10 years, 15 years, up to 35 years. Just look at this particular tabular column. Assuming a 10% return on investment on this SIP, say take a time frame of 15 years, assuming that you do an SIP for 10,000 rupees monthly for a period of 15 years, your total investment value is 18 lakhs, but with a 10% compound interest, your return will be, the total corpus what you will build is around 41 lakhs. 41 lakh 44,000. And again, just look at it, another 5 years, you just give another 5 years, okay, you continue the SIP, your investment value will be around 24 lakhs, and the outstanding value will be around 75 lakhs. Just have a look at it. Just you are giving 5 more years, from 41 lakhs, the money, the outstanding value will be 75 lakhs. So it goes on like this. More the number of years, you get the best of the best compounding. Just look at the corpus value between 25 years and 30 years. Okay, 25 years, okay, you'll get about 1.3 crores, and at the 30th year, you'll get about 2.2 crores. This is the beauty of power of compounding. And same with respect to your lump sum investment. You put a 1 lakh rupee lump sum investment, again, just an illustration, over a period of time. Just look at the same 10% indicative returns, okay, for a 15 years, 25 years, 30 years, and 35 years. If you just look at it, between 10 to 15th year, from 2.5 lakhs, money is grown to 4.1. From 15 to 25, another 10 years, money is from 4.1, it goes to 10.8. So this is the power of compounding, so which you will have in your portfolios if you just give the respective time frame for your portfolio to grow. So this is the beauty of power of compounding. That's reason, okay, power of compounding is called the eighth wonder of the world. And we do have, facilities in SIPs to do a top up. Assuming that someone starts a SIP, say for example, in this illustration, 5,000 rupees, and they'll just forget it. Incrementally, they may not plan to add SIPs. So there is an option called SIP top up, where you can just top up your SIP amount. And the right hand side tabular column, if you just look at it, okay, if you just do a top up of just 10% per annum, okay, over a period of 10 years, the accumulation value difference itself is close to around 3.5 lakhs. Normal SIP, you could have accumulated 6 lakhs, and the SIP with the top up, you could have accumulated 9.5 lakhs. The outstanding value, assuming with a 12% compound interest, it will be 16.4 lakhs in SIP top up, and a normal SIP, it's 11.2. So please don't ignore on increasing your SIP amount over a period of time also. So next is systematic withdrawal plan. As I just told, there's a fixed amount which will get moved out of the mutual fund. It goes back to the respective customer's bank account. So especially this facility will avoid people to go and take the money in the wrong time. They can use this facility to withdraw the money over a period of time. So with the tax adjusted, because the taxation plays a major role in mutual funds. So with the tax adjusted, especially in the debt mutual funds, with the tax adjusted, I'll just show a slide how this works. With the tax adjusted, the returns can be much more. This is a illustration again. Systematic withdrawal plan. Even if someone could have invested on the peak of the market on 1st January 2008, a lump sum amount of 10 lakh rupees, okay, with a monthly systematic withdrawal of around 6% per annum, every year he is going to top up the systematic withdrawal plan by 4%. The first complete year, okay, he could have got 5,000 rupees. The second year he could have got 5,200 rupees, like that. Every year there is a top up of 4%. The money payout which happens to the bank account of the customer grows over a period of time. So in this, after adjusting the long-term capital gain, short-term capital gain tax, and so on, this is an equity fund example. The valuation after 10 years, the valuation, that is, someone could have invested in 1st January 2008 on the peak of the market, even on the peak of the market, the valuation on 1st January 2018 was around 11.5 lakhs. 10 lakhs invested, 11.5 lakhs. By the time he could have got back into his bank account is about 7.2 lakhs. Technically, if you just work out with the tax, the short-term capital gain adjusted to the long-term capital gain and so on, technically customer could have paid zero tax. So there's a beauty which is there once you use this option of systematic withdrawal plan also. And the next strategy is about investing into debt mutual fund. So a lot of people at this point in time especially think that mutual funds means it's only equity. Debt mutual funds are also there. Different products for different time frame, for a different risk appetite. So all the different categories are there. I'm just giving a small glimpse of this. Starting from 1 day to any number of years, there are products which is available in the debt mutual fund space. If you just look at this, we do have products starting from liquid plan, okay, in the mutual fund industry, where an indicative investment time frame of 91 days. Then you have a product for 3 months, 6 months, 1 year, 3 year, 4 years, 7 years plus. And there are products called in the dynamic space where it ranges from 1 year to 10 years also. So every product suit is there according to the time frame, according to the risk appetite of the customer. You can just choose and just go and invest into debt mutual fund. And very, very important factor with respect to debt mutual fund is, okay, the government of India has given a superb benefit of indexation. So indexation, all of you know the basic of indexation. The debt mutual fund is having an indexation benefit. In this illustration, what we have just given is an assumed debt mutual fund return of around 6% and a traditional investment of around 6%. The post-tax return on the debt mutual fund with inflation adjusted, that is indexation, with indexation, customer will get around a post-tax return of around 5.87. And on a traditional investment, on a traditional investments like any of the deposits and so on, or any other debt instruments, where the post-tax return, assuming that this customer is there at the 30% tax slab, they'll get only about 3.93. Why we have assumed a 6% at this point in time? As you know, the fixed instruments available in the markets are there in the range of 5 to 6 or 5 to 7%. So post-tax debt mutual funds actually gives a very good edge for the customers' post-tax returns. So next strategy is about asset allocation. What the research says is 90% of your wealth can be created only by asset allocation. What is this 90% of the wealth can be created? Say, assuming that someone is investing into the equity markets in 2002 on the peak of the market, and again he comes out of the markets by 2007. Again, he goes and puts that entire money into real estate by 2007. He comes out of the real estate in 2013. Again, in 2014, he goes and invests that money into equities. And 2018, he moves the money out of equity and he is investing into a debt mutual fund. I don't think so. If someone could have invested, if someone could have timed this so perfect, they could have made a huge money. But hardly 1 or 2% of the population, investing population, could have done this. I don't know, even 1 or 2% of the population could have done this. So that's the reason the concept here is, if someone is able to do a proper asset allocation, their returns over a period of time can be definitely be better off. What is this asset allocation? Automatic asset allocation, auto rebalancing asset allocation is buy low, sell high as a concept. There are products in the mutual fund under this category called dynamic asset allocation. Buy low, sell high is a concept. Basically, when the valuations of the markets are high, they sell and move the money to debt. And from debt, when the markets are low, when the equity markets are low, from there, the money will get invested into equity. So this is a graph which shows this red color line. Basically, whenever their index are high, the investment into the equity is low in these products. Whenever the index is low, the investments into the markets are high. So this is how this product works. This is an auto rebalancing. We are just left it to the fund manager's choice. They'll take care of switching between equity and debt. There are products available where rebalancing also happens. So there might be some questions with respect to investing into this particular category of dynamic asset allocation. Can you just do an SIP? Yes, you can just do an SIP. This is an one fit all. So even starting from an entry level customer to any old age customer, mid age customer, any amount can be invested. A retail customer can invest, a super HNE can invest. So anyone can invest. That's the beauty of this particular category. And fourth point is making a core and a non-core portfolio. So I'm very sure Lokeshwari will take up these detailed one with our eminent speaker, Mr. Bharat Shah. I'm just giving a small glimpse of this. Basically, the investment portfolio, what you build, has to be, the base has to be debt. The base has to be debt. It will give you a basic income. Or debt, you please build a hybrid, which gives a stability, which is basically the hybrid products, which is the dynamic asset allocation products. Then you build equity, which will give growth in the portfolio. So you need to have a combination of all the three so that you can build a robust, systematic portfolio over a period of time. So a lot of people are investing only into equity with respect to mutual funds. Our humble suggestion is to build a portfolio with a combination of debt, hybrid, and equity. Next is about mutual fund plays a very, very prominent role in planning your financial planning, basically to plan the financial planning over a period of time. So this is the left hand side is the life cycle of the customer. Right hand side, what we are saying is basically the first, you accumulate wealth, then the wealth transition need to happen, the wealth distribution need to happen, then probably it can just transfer to the next generation also. Everything can be done just by proper planning. There are tools, products for different time frames, which is available in the mutual fund space. These are the short-term and long-term goals every individual will have. All the short-term and long-term goals can be addressed, can be planned through financial planning through mutual funds. Next, as I just told, you need to have a combination of equity, debt, as well as the dynamic asset allocation as products to have a robust portfolio. Basically, a lot of people might think, you're just talking about equity, you're just talking about debt. What can be the indicative time frame, and what are the possible goals? This is what it is. Basically, if you have a 1 year time frame, less than a 1 year time frame, stick on with more of a liquid money market kind of products. 1 to 3 year medium duration debt products. Then 3 to 5 years dynamic asset allocation products, what I just spoke some time back. And anything only with 5 year view, if you have, then you need to come into equity mutual funds. So this is a broad structure of investing into debt, hybrid, and equity mutual funds. This is basically the investment cycle. What if someone wanted to invest, their expectation is basically to have a very straight line graph. The growth, everyone expects to have a very straight line graph like this. Like this, put the money into a bank fixed deposit. I wanted the equity also to deliver in the similar lines. No, it can't happen. If you just look at this, the equity linked products will be like this. You'll be having a lot of ups and downs, but over a period of time it will deliver better than the fixed income products. Then actually what happens is, investor is in need of money on the bottom of the market. What happens is, when the money comes to the par value, he goes and moves out of the market, and he will not enjoy that returns. His power of compounding will not happen. That's the reason we advise, come with a proper time frame so that everyone can just make money over a period of time. And also, if you just look at this, with respect to equity investments, this black color line, the black color graph, which is there, the line is there, is basically, this is how the fixed income grows. The equity mutual fund, expected equity mutual fund returns from the customer side is like a green color graph, what I have just shown, the line what I have shown. But actually what happens is, as I just told, this orange color line which is there is the equity markets will be like this. But when you just do a proper asset allocation, okay, then your volatility can be relatively minimal, and it will be in lines with the equity mutual fund products. The returns can be in line with the equity mutual funds. So over a period of time, if you practice asset allocation, definitely you can just make a good returns. Again, with one more poll, I'll just close my presentation. We can just go for a next poll. A question to all of you. Rupees 1 lakh invested in Sensex in 1979. What is the current value? Poll answers, please. Yeah. 46% of the customers have told it's 3.57 crores. The answer is right. Okay. This is what it is. Yeah. 1 lakh invested in BSE Sensex on the inception date. Today it's 3.57 crores. By looking at this number, please don't jump into equity tomorrow at any point in time. Okay. You need to practice asset allocation, happy investing. So wish you all the best. Lokeshwari, over to you.
Yeah. Thank you so much, Harish, for that very succinct presentation. Yeah, so I was really surprised that both your polls got the right answer, got the maximum hits. So that shows the kind of viewers we have with us right now. And I think the point about spending more time in the market is also very important, and it also proves my point about watching the grass grow. Yeah. So it's missed. So I think we'll just. So we'll move on to the next part of our webinar. It's my pleasure to invite Mr. Bharat Shah to the webinar. Mr. Bharat Shah is the Executive Director of ASK Investment Managers, and he has over 30 years of experience in the Indian capital market. He's very well known for his pithy insights on investing, which he shares in an extremely lucid way. And I particularly like the way he's so generous with knowledge sharing. So, Mr. Shah, let me just start with a question that I think all investors in equity mutual funds and general equity also are asking. So why is this disconnect between the economy and the stock prices? Because market benchmarks have actually recovered over 40% from the March lows, despite macro challenges and contracting corporate earnings. But what are stock prices telling us?
I'll answer it in three parts, Lokeshwari. First, markets are forward-looking, relentless pricing machine, while economists in general is a tribe of people who live in the past and who all the time seek to make inferences from the past for the future. While markets are engaged in the task of gazing into the future, making appropriate conjectures by staring into that future, discounting it to the present, related to the price as it stands compared to what it believes that discounted future today represents, and put the real money where their mouth is, unlike economists who unfortunately are more in the armchair kind of activity. And therefore, there is a fundamental difference between the view of the markets and the economists, because fundamentally, investing is more than 95% about future and maybe less than 5% about present and the past. While that is a required trait as far as investing is concerned, most Homo sapiens don't think of life in that way. Most of them spend time too much either brooding or mulling over the past or dealing with the present, while it is the other way around as far as investing is concerned. And economists is a special tribe within the Homo sapiens who by and large spend way too much into the past. And therefore, what economy is showing is an occurred fact today, while markets today would reflect what it believes tomorrow will be the case. Unless and until we understand this fundamental difference of viewpoint, this issue of the disconnect would always prevail. Secondly, I would say it is inappropriate, if not dangerous, to dismiss markets in a contemptuous terms, which a lot of bystanders and observers and even market participants tend to do. This is not to say that markets don't make mistakes, but it will be a fatal error to treat markets in dismissive terms. Markets, by and large, reflect in a pretty forthright manner what it believes the view about the future is. The view can be flawed at times, the view can be exaggerated, but it will be a big mistake to believe that markets are bizarre, that markets have lost the marbles and they don't know what they are doing, which of late particularly has become a fashion to say. Every second day I read something or the other which talks about Robin Hood investors, and I think these are pretty arrogant expressions. We should respectfully observe what markets are doing. I would maintain a healthy and reverential distance from the market. It doesn't mean everything that is suggested by market is a gospel truth, but it will equally be an error to assume that markets are foolish and irrational and they are just a den of gamblers, which often is implication stated or unstated in many of statements that you see from the observers, bystanders, economists, even market participants. I think what a healthy attitude to keep is not really to judge markets too much. Healthy attitude and a more profitable and a proven attitude over some 300 plus years of recorded investing history shows it is far more prudent to focus on individual stocks, individual businesses, their merits or otherwise, and to do that over reflected long term rather than reflecting every near term or a short term event as if it's a permanence. If we avoid these mistakes and remain focused on a bottom up basis on businesses and keep evaluating and keep judging or revising one's own opinions if need be in terms of what you believe that conjectured future is. Therefore, value is not a static number that you arrive at one time with which you compare price at a given point of time. Value is an evolving idea. In any case, with the time value of money, value itself has to compound based on that IRR. But there are many other levers which may change value than what you think about it at a point of time. Sorry. So that would change from time to time. And we have to remain alert, watchful, at the same time, careful and long term. Uh, it has got to be a judicious balance between confidence about what you know and what you do, at the same time, remaining open to possibility that there can be a scope for error. Therefore, that is how I would look at the situation. Markets probably seem to reflect that the challenge of pandemic is over wrought and over kind of dealt with. And to that extent, markets probably are implying that while it's a challenge and an important challenge, not a minor one, and there is an impact on economy and on the businesses, their earnings and their top line, and therefore their prices, because the value may alter because of that. But markets seem to think that transient and temporary or a near term should not be confused as permanent one.
Okay, point taken, sir.
Lokeshwari, you need to put your video on because I am staring into the kind of a distant horizon. If you
Okay,
put your video on, I can see the face. So,
my video is on. Can someone help Balcha's view?
anyway, go ahead. If
Yeah. I think they have to help you.
your
Yes,
video was
sir.
on earlier when we talked. So
Yeah, I think the Arvind or someone can just help with putting my video on while I'm talking.
sure.
Yeah, so the second question I'd like to ask you, Mr. Shah, is that I know that you believe that P ratio, the price earning ratio, is not the right prism through which equities should be evaluated. And I think this has become even more relevant now against the background of the earnings contraction that this pandemic has brought about in this current fiscal. So we see the PE multiples actually shooting through the roof. I think Nifty 50 is at 30 times. And this actually making investors even more scared. They're looking at the PE multiples and it's looking really sky high. So what would you tell investors? What is the right metric that they should be looking at to evaluate, if equities are rightly priced or not?
First of all, what you mentioned, the contraction of earnings is not entirely correct. If you see number of businesses which have declared the results, today Divi's Laboratory declared result and you saw the earnings expanding by 81%. A few days back, Britannia declared results and earnings expanded 117%. There are scores of other results I can narrate where earnings have expanded in a pretty robust manner. I mean, numbers which even in most normal times would be regarded as extraordinary. Uh, 2 days back, you saw high quality agrochem and farm nutrient maker PI Industries, which reported the earnings which grew upwards of 50%. A few weeks back, you saw the Coromandel International results. So there are plenty of businesses which have shown expansion of earnings, contrary to what many people might have thought. And in many cases, I myself have been pleasantly surprised by the kind of robustness and the strength that the entrepreneurs and the businessmen and the businesses have displayed in dealing with a challenge in a quarter where April was virtually shut, May was materially shut, and even June was substantially in the impact zone. In a quarter like this, for businesses to expand their business by 20 and 30 and 40% is nothing short of extraordinary. So I would say we need to temper that assessment with more data that earnings have contracted. Of course, earnings would contract in case of number of businesses.
Yeah, yeah. I was
That
talking at the headline number, yeah.
not
Or
headline.
at the aggregate level, yeah.
At an aggregate level, also one will wait and see what will happen over a period of time.
Yeah.
But that is a headline aggregate number is a mixture of orange and apple and lemon and watermelon. And that's not a very good way to look at it. Secondly, the question about price earning multiple, if you ponder over it, you realize why it is an inappropriate way. Price earning multiple is about price today and earnings in some period nearby, say next 6 months or 12 months or 2 years. Now, business is not about 1 or 2 years of earnings. Business is about lifetime of earnings. So how can a shallow number like price earning multiple capture that reality? Secondly, price earning multiple has everything to do about profit after tax, while real measurement of the success or otherwise of the business is the cash flow. Profits in the hands of clever accountants can acquire any shape. And even if profits are not manipulated, it is not the profits that really dictate the value determination. It is really the cash flows and their growth and their durability. Therefore, a measurement which is resting on a kind of a four-pillar cannot really represent the real dimension. Third, price earning multiple, given the fact that it is so much about immediacy, it doesn't reflect the time value of money, which is the fundamental basis of evaluation. Unless, and I talked about investing needing for you to gaze into the future, make appropriate conjectures and judgments, discount or bring that future back into the present. And the only way you bring future to the present is by discounting the future at a given rate. Therefore, any assessment of a value has to stem essentially from time value of money has to be captured there. PE doesn't really do anything of that kind, and therefore it can never really be a measurement. Fourthly, and not really last, but price earning multiple is not capturing durability of earnings, but it doesn't even capture the idea of the quality of the rate of growth. More than even quantum of the rate of growth, it is the quality of rate of growth, which is even a little higher contribution to determining of the value. And it is simply absent any connotation of the value of the or in weaving that judgment about quality of the rate of growth into the valuation picture. Therefore, only realistic way to judge value is basically to have some notion about the size of opportunity and the capability and competence and value system and the governance of the management, which is to extract that opportunity. That should give you some notion about growth and its pattern in future. But more importantly, that growth has to be not just the growth of the top line or the bottom line, but that of the cash flows. Furthermore, you need to temper that assessment of the growth with the quality of the growth. I can't in this short description really summarize all the nuances about quality of the growth, but it is very, very vital factor which allows rate of growth to result into matching higher or lower economic value creation than what a plain reading of the rate of growth will imply. And all of these, in a way, has to be put into a crucible or a pot boil of cooking of that value, which is a fair bit science, but even a bit more of the art. That value today and where price today is the only logical way to relate that equation. And of course, that value itself will evolve over a period of time, partly due to the time value of money. Other things maybe because of the assumptions that you built may change. One final thing, price earning multiple really should be inferred after judging the value. Therefore, price earning multiple is an output. It is not an input to determine a value. So there is an intellectual confusion when somebody uses a price earning multiple to determine the value, because you are using what is an output of a method to treat it as an input and arbitrarily arrive at a value. For example, reports and voices will tell you that P P is this much, and we believe P should be that much, and therefore price should be that much. Now, what is the logical way to say that P should be X or Y or Z? There is no explanatory logic or sound method behind it, and therefore that itself is price earning multiple, purely conceptually speaking, is a fundamentally flawed idea.
Okay. A lot of ideas to mull upon, Mr. Shah. I think people will have lots to think about after that. So if we come to investing strategies, so the two most things they talked about are the value and growth. Value investing has not really been working too well in Indian market over the last few years, and growth has actually worked. You too, I think, started as a value investor and then became a growth investor going ahead. So do you think the market structure itself has changed in such a way that all the action is getting concentrated in the top 200 stocks, so that makes only the growth strategy work better, and growth is actually, I mean, value is just a hypothesis to work with, a fantasy kind of a thing?
Very important question, and let me answer it in four parts. First of all, I never have had a style of a value or a growth or whatever people may describe. So I don't know from where did you make that conjecture that I was a so-called value investor and I become now so-called growth investor, because it is that is not how I thought about my investing. Neither today, nor 10 years back, nor 30 years back. On that fundamental construct, broadly, my philosophy of thinking about investing is reasonably remained on the same parameters. Some nuances may have undergone change, but those are more mechanics and not fundamental tenets. Secondly, I think there is a lot of, much like price earning multiple, is an utterly confusing idea, and simply because it is simple to comprehend and therefore it is abused. But equally, I think investment literature and even media is filled with reams of paper about so-called difference between value and growth. To my mind, investing invariably comprises of three most important ideas, apart from some other ideas, but let me focus on these three important ideas. There has to be an earnings growth in future, sustained, predictable, durable, and simple to understand. That compounding machine kind of a growth is an absolutely essential ingredient for value to be created and to be expanded. And without that growth, investments become a bit like fixed deposits and cigar butts. And if the growth gets procrastinated or delayed further, then it becomes a reducing or a negative fixed deposit. Therefore, growth is vital. Second, very importantly, as I alluded to earlier, is the quality of the growth. Growth in itself is important, but not enough till it is supplemented by the quality of growth. It is quality of growth which makes growth in absolute sense from becoming contributory rather than toxic. Therefore, when the quality of growth is superior, same amount of growth in the hands of 2 or 3 or 4 different businesses will result into different outcomes over a period of time. Some may produce even a superior returns than the underlying growth rate over a period of time. Some will produce at par, some will produce lower, some will produce zero, and some other terrible businesses will produce negative returns over a period of time. Therefore, the second dimension is the quality of the growth. And the third is important aspect, which is the value. Value in the terms of margin of safety. Value today and price today is a definition of margin of safety, the gap between the two. Value tomorrow and price today is a definition of compounded returns that you are likely to make over a period of time. And therefore, it implies two very clear things. At a time when you are thinking about your investment, you need to have a notion about what is the value today. And when you are thinking in order to decide what is the margin of safety and that much extra one time to your returns kitty. And when you are thinking of long-term returns, because investing has to be long-term by definition for it to be profitable and to be sensible. And none of the notions of hyperactive world of social media and short-termism really has changed anything about the long-term notion about equity investing. But when you think about that long-term, the compounded returns that you are seeking, the notion comes out of value tomorrow and price today. It is that margin of safety coupled with growth and the quality of growth combines the troika of investing in terms of assessment. Management quality, size of opportunity, the character of business which has a contribution to determine some of these, all are important other factors, but let me focus on these three. Therefore, investing for it to be valuable has to have a growth. Without growth, it will become a cigar butt. But if it is growth without quality, it can be corrosive growth or actually it can be destroying growth. And if it is growth as well as a quality of growth, the package has to eventually conjure up itself into some notion of what is the value today and therefore a margin of safety, because even a great business, a great quality and a terrific management with a large size of opportunity and long-term future solid growth, you still want to buy at a price which leaves a margin of safety, which means price by definition has to be somewhat cheaper today when you are acting upon it compared to value what you believe exists today. Therefore, it is never a question of either or. It is both value. Growth has to be qualitatively sound, and that package has to be bought at a value price. To my mind, that and that alone remains a long-term nectar of investing.
Okay, point taken. Um, So Warren Buffett had said that it is temperament and not intellect that actually helps investors. So if you say what kind of temperament that investors should cultivate, to actually make them help them navigate phases such as these.
An absolutely vital question. In fact, at the core of what investing is about. What Buffett has said is, to my mind, is a pinnacle of truth. Investing, of course, requires some amount of talent and some amount of intellect, but it doesn't call for you to be a genius. It doesn't need you to be an Einstein or a Newton, because if that kind of an extraordinary talent only were needed, then people like me and many others wouldn't have been in this market. Fortunately, it doesn't call for such extraordinary level of intellect or anything. What it calls for, of course, is some amount of grace and reasonable amount of intellect. But more than the intellect, what it calls for is really a temperament, a mindset, a set of attributes within which lets you deal with the machinations and the volatility and the violence of the market. Markets are forever trending and forever altering machine. And whether you like it or you don't like it, whether narrow kind of volatility, 10%, 15%, 20%, or thereabout, which is normal volatility of the market, and is to be expected at any point of time, whether upside or a downside. But that's a routine and nothing very unusual. Of course, when it goes to 40% and 50% and 60%, that becomes more in the realm of violence rather than volatility. But even that over longer period of time does occur and is a part and character of the market. Therefore, market is a beast that at times is in a state of exaltation, at other times it is in a manic depressive mode, at times it is over optimistic about things in around, and at other times it is really suffering from severe bout of depression. And these mood or sentiments will keep yo-yoing in the marketplace. At times with optimism, other times with pessimism, at times with greed, other times with fear, at times with reason, and at other times with emotion. These will continue to intersperse, which is where price will have a reason to deviate from the underlying value. Otherwise, value occupies the centrality. Prices logically have to gravitate towards the value, but these emotions, these changes in the minds of the participants in the market of up and down, which is what is causing prices to deviate from the real underlying value. But as the period elongates, and which is why investing has to be long term, the emotions, the overburden of the sentiments slowly but clearly reduces to zero or negligible, and therefore price essentially is reflective of the value. Value is a reality and price is a shadow. But to the people, to many, that shadow may appear like a reality, while value may appear like a distant, decipherable kind of an idea. Sometimes the shadow runs ahead, sometimes behind the reality. Sometimes the shadow elongates ahead or elongates behind, and sometimes it merges with the reality. But value remains what it is. Price is only a dance of the market in dancing around the value. Therefore, prices will fluctuate, and at times more, at times less. We have to recognize this character of the market, that markets are going to do this. And that is while it is not an enjoyable trip when markets are in a state of distress and things fall like a pack of cards. But it is important to recognize that that is going to happen, whether you like it or not. Normal volatility will occur all the time. Violence may occur in 10 years, 15 years, 20 years, 25 years, but it will occur. So long as you know the value, so long as you understand any change in terms of the long-term equation of that value, and so long as you have a discipline to weaving that value with the price today and extract a margin of safety in your favor, and thereafter you have a wisdom to stay the course, then that is where the game lies. Intellect helps you in judging the value. Discipline helps you in having patience and a mindset to wait for prices to be attractive compared to the value. And it is the wisdom and resilience of the mind and calm and serenity within which allows you to let that equation flow over the logical long-term period rather than fritter it away into the dance of market in near term. That and therefore more than the intellect, it is the discipline and the wisdom and the temperament which are critical, while intellect in itself is required, but is not enough. And much like investing is both science and art, but it is a bit more of an art and little less of a science, while it is both.
Okay. Um, I think a lot of viewers are asking questions about passive investing. They are saying, is it a good idea to move into index funds or ETFs at this point? So, what do you think, sir, about passive investing?
No, there is a lot of merit about it, without any question. Long-term history shows that not too many people are able to beat the markets. And yet, if you are going to pay them hefty fees for even producing just the equivalent of the market results or below those results, and yet you pay for that punishment, then it's clearly a act of self-flagellation. So clearly, that is not in the interest of an investor. But equally, it is true. While investing is a greater act of wisdom and discipline, and maybe a little less of intellect, there are enough people who have shown a path and who have demonstrated that with a discipline and serene mind, which is a good judgment of the values and good judgment about the character of the managements and the people, and have broader understanding rather than a lot of small and at times petty peccadillos or minor details. It is combining that vision along with the methods of investing, along with the temperament, which is what is critical. But in the hands of those investors, over a long run, clearly there is a potential and ability to beat the markets. And there are enough records which show that. But if an investor can't do that himself, then obviously he has to find somebody who can do it. Investing, much as it may sound simple to do, is not a DIY. It is not do it yourself kind of a scheme. You can buy a fixed deposit without too much of application of mind. You can buy a house. You can probably buy, even for buying fixed income mutual fund, maybe you need a little bit of skill and knowledge to ensure that you don't end up with the grief sand, you know. But equity is far more specialized. The ease of participation in terms of buying and selling should not deceive you into believing that investing is easy. Investing is simple to understand. The nuances underlying are simple, but it's not easy. And therefore, if you can't do it yourself, you have to find somebody who can do it for you and who can generate that extra so that you're paying in something out of that extra is well worth that effort. But if you can't find somebody whom you can trust or whose capability you have developed a confidence in, and not just capability, but his value system that you have developed confidence in, then next best option is either to do it yourself, but which if you have concluded that you can't do it yourself, then next best option is to give it to the index. But if you make an effort and do something, like you do make some effort to find the right doctor for your needs, It's not as if you just flip a coin and decide which doctor to go for. So you do make some efforts, you do make some inquiry, you do make some analysis. Some amount of inquiry of that kind, maybe little more searching may be needed to understand people whom you can trust, whose trusteeship capability you have faith in, and their long-term capability, not just the past record. Because past record is what it is. It is doing that in future, which is critical. And therefore, process, discipline, replicability mindset over a long run, a kind of a demonstrated level of level-headedness in crisis situation. All these are critical aspects that you need to think about the manager whom you want to entrust. And that effort is well worth it if you find that manager and entrust that money, because that manager hopefully will create distinguished results compared to what the index will produce. But if you can't do that, then it is better to leave money with the index. At least you'll save the fees.
Okay, thank you, sir. I think we'll now move to the audience Q&A, but before that, can we have the compliance slides? Please make sure that you have your nomination of mutual funds in place. It's easy for transmission.
Sorry, you are asking me anything?
No, sir, we are playing the disclaimer and the KYC
Okay.
slides.
Sure.
Yeah, so I think we'll take some audience question now. There is one Mr. Manoj Wantedu who wants to know whether it makes sense to buy gold now, because I think gold prices are really surging and everyone is very interested in knowing where the gold prices are going to go. So Harish, you want to say whether it's a good idea to put money into gold ETFs or something like that?
See, with respect to as money is chasing the safe haven, gold is one of the factor where the gold prices are going up. What is the kind of money which got printed in US and the kind of liquidity which is there. That is also one of the factor. But with respect to the gold view, yes, as a part of an allocation on an overall portfolio as a hedge tool, gold can be looked at in the portfolio if they do not have. And probably as a bit of a run-up which has happened now in the gold, probably they can just take a calculative call and then just based on the requirements in the portfolio, they can take a call into the gold.
Lokeshwari, I have something to say
Yes,
about
sir.
it.
Yeah, yes, sir.
Well, it is important to follow the asset allocation discipline, but trying to think of as gold as some nectar of life is a mistaken notion. If you look at 110-year record of gold, in dollar terms, it has produced less than 1% compounded return. And in dollar terms, that will tell you what is the real story, because gold has no real economic value. It is an article of consumption, so it may have a consumption utility, and but it cannot have a really investment potential, because by definition, investment returns is a function of economic productivity of an asset. Then only you can measure the value, and then only you can have a notion of what is a likely return that you will make. And gold doesn't satisfy that condition. What asset allocation discipline will imply will be two physical assets, which is gold and real estate. Both are articles of consumption. House that you need, or an office that you need as a business asset, or a factory, or whatever. And gold is an article of consumption, is jewelry or the adornment that you want to wear. Perfectly fine. But it is a mistake to treat it as an article of economic value creating investment. That is where the rub lies. Now, past is deceiving because on the top of inferior dollar return, because of the chronic and long-term mismanagement of economy, you added two more elements which kind of showed up as a return. One is chronic inflation into the economy. Second was rupee depreciation. On top of that negligible dollar return of gold, these two elephants added seem to give an impression of a respectable looking high single digit kind of a gold return over a few decades. But if economy gets into a better management mode, as I believe it is becoming, and is inflation gets tamed, and as we behave on our external front, rupee depreciation has to be moderated compared to the past. I would say it will be kind of difficult to think of gold as a source of return. One has to be very careful. Second is a mental trap. Markets are a place which is designed to put you in a trap. And whether it is equity stock prices, whether it is bond prices, or whether it is gold price, when prices go up and up and up and away, at some stage people succumb. And that is exactly where the risk is lying. When you get trapped into a dance of price rather than judgment of value, that is where you are actually taking one of the highest risks. And anybody who thinks merely because of the price change of gold in last some time is very attractive and as a flight of safety, you may have to be careful, because you may end up being on the other side of the table at a time not of your choosing.
Okay, point taken. Harish, one Mr. Padmanabhan wants to know that he wants to invest 50,000 with a time frame of 5 years, but he needs capital protection with growth for his son's education. So should he go for debt funds or equity?
Yeah, see, with respect to mutual fund, as we have just played this risk factor, we can't use a word called capital protection. So
Okay.
as he's having a time frame of 5 year plus, and there is definitely a compulsive need, I think he can have a bit of a hybrid plus basis debt, and over debt he can just build a hybrid also, a conservative hybrid kind of a portfolio.
Okay.
Probably 60-70% debt and probably 30-40% are conservative hybrid products. As 5 year, there is a definitive need which is there. Definitely not
Lokeshwari, can
equity.
I add a point there?
Yes, sir.
Well, if you don't treat equity as a gambling device, and if you think of equity from a real long-term point of view, I would say it is one of the safest assets you can ever find to invest. And what are the ways of not treating it as a gambling device? A, you buy quality and not rubbish, which means you buy diamonds and not marbles. And secondly, you think of your investing from a pretty long-term perspective. If you buy quality and genuinely value-creating asset, but mistreat it with a short-term flirtation, you may take up in risk which is unanticipated. Equally, if you just because you store pebbles for a long period of time, they don't turn into diamonds. Therefore, you need both quality as well as patience for equity to yield. If you do that, then, and if you don't treat equity as a gambling device, any long-term period in equity is a very productive one. Now, whether 5 year is that or not is hard to say, but I can definitely say anything less than 5 year you are essentially flirting and you're not really talking of investing. So if your horizon is limited only to the 5 years, then probably you should think hard about it, that temperamentally whether you are really equipped to get superior returns or results for your capital. Thirdly, there is nothing called zero risk. Capital protection comes when you buy something sensible, and you buy something sensible at a sensible price, and then you have patience and discipline to hold it for long run. If you do all of that, that means you can choose well. Not only you can choose well, you can buy well, that what is worthy to be bought, and then you have a long-term patience. These three, if you have, then in all probability it is as low a risk as you can take. But nothing in life is zero risk. Even your fixed deposit in a bank is not 100% guarantee. And you've seen what has happened to some fixed income mutual funds, where instead of making 5% or 6% return in a year, many have ended up with 20 and 30 and 50% losses. So nothing in life is risk free. So you have work to do, and if you can't do that work yourself carefully, then you have to find somebody who can do it for you. But in absence of that, there is no lazy returns. Markets have no obligation to make you rich and wealthy simply because you put some capital to work in the markets. Markets are in fact designed to make you fail. It is your duty to act with discipline and extract returns.
Okay. There is one question from Shalini. She says, how do you judge the quality of a company's growth? Mr. Shah, you made that point. So,
Uh, well, quality may appear as intangible, but an unseen but a real lever which is at work to convert the potent force of the growth. Ultimately, what is the direct connect in a long term? The true earnings power, the long term earnings growth is a damn good proxy for the long term value creation or the returns to be earned. In other words, equity stocks are slaves of the earning power. Behind that simple looking truth, there are many other multiple ideas, and with the shades of intangibility which needs to be unraveled. Quality of growth is one of the important other such idea. Apart from, let's say, quality of management, understanding size of opportunity, understanding character of business, even understanding mathematics and art of valuing a business. But that quality let's connect between a given rate of long-term earnings growth in future, say X percentage per annum compounded, into a matching or reflecting outcome into economic value created per annum or investment returns per annum, whether those investment returns will become X percentage per annum, like a mirror image, or it will become higher as X plus Y, or it will become lower at X minus Y. In pathetic business, it may end up close to zero or thereabouts. And in downright rubbish and inferior businesses, it may end up as a negative kind of a draw. Therefore, growth is not a panacea for making automatically returns. It is the quality of growth which, combined with the rate of growth, which delivers the final punch. Therefore, that quality of growth is an important idea which needs to be understood. It can be seen in the kind of a protective armor that the business has created around itself called moats. It can be reflected in the pricing power. It can be reflected in relatively frugal need of capital than the others in the business, or it can mean a greater amount of output on the same amount of capital compared to the others. It will have various dimensions in that qualitative notion. These notions, when you have understood and kind of try to make conjecture about the future, is sum total of that quality of growth. But that quality of growth, in my opinion, is not just as important, but even more important than the rate of growth. Investing is less upfront than people believe it to be. Humanity feels more comfortable with the tangibility of the things, but investing is more about intangibility. Price is tangible, but it is value which really is the master. Uh, Price earning multiple may sound like a mathematically precise number, but it is value which is the draw. Similarly, rate of growth may look real, is a definite number, but it is the quality of growth which is a far bigger impact. Uh, Quality of growth and understanding that is a book by itself, and something that needs to be dealt for long period of time. So beyond this, it will be tough for me to take you through so many more nuances into it. But suffice it to say, corrosive businesses abound, which by definition are destined to die and diminish or corrode. It is only very few qualitatively sound businesses, and which only by definition will have a value over a period of time. Others are merely excitement and dance and depression of the market. Ultimately, they'll be grounded to dust in the giant flywheel of markets. It's only very few businesses which have character and what it takes to create value, and that hugely resides on the quality of the growth.
Okay. Harish, I think there's a lot of interest in guild funds because people are asking whether guild funds are a good idea for the next few years because I think they've delivered pretty well for investors.
Yes, yeah.
Yeah.
To put it in one line, with the current levels where the yield is and considering the liquidity situation, definitely they can invest. But as everyone know, guilt, being a debt, guilt is also not an one-way up return. It will have, based on the interest rate, it will have its own volatility. If someone is able to take that volatility, definitely they can look at gilt investments also.
So, Mr. Shah, any last words for investors about how they should act in this phase, this very difficult phase?
No, investing is a continuous thing, so there can never be any last word. I mean, anything that we think is a last word is our own arrogance. So I don't want to be accused of such an arrogance. There can't ever be any last word as far as investing is concerned. But I would say a few things. While investing is about returns, risk control is even more important. Much as I talked about, while growth sounds palpably real, but it is the quality of growth which is even more critical. Secondly, investing is not do it yourself kind of a scheme. Thirdly, investing is not a get rich quick scheme either. If you do not have a patience and you do not have a mindset which can appreciate that idea, and you don't have a temperament which otherwise will fall prey to the market machinations exactly at the wrong point of time when the highest amount of discipline is required. Therefore, it is not a get rich quick scheme. It is compounding and building over a long-term period. Fourth, more than the intellect, as Lokeshwari referred to earlier, it is temperament and discipline and wisdom, which is even more important role in quality long-term investing. Fifth, more than the highest and top-notch stock selection, it is the staying power, which is even a greater influence on the final results that you will obtain. And therefore, that is something which one should never lose sight of. You don't need to be a genius to find perpetually the best of few names in the marketplace available. More than that, your ability to work with reasonable and decent ones, but ability to deal with them with an equanimity and serenity over a long run, which is going to be very big difference. In many other ways, equity investing is not about highest, it is about optimal. It is the quest of the highest which derails objectives and which derails even bright minds. The none of the investing, whether in why just equity, even other for out of the asset allocation, as I mentioned, fixed income and real estate are actually pure consumption. Really, they are not investment assets. Fixed income is a way of ensuring that your life goals and your needs and your even some amount of contingency can be taken care of through legitimate amount of income investment into fixed income, so that it doesn't derail you when you are faced with difficulty. It gives you robustness of the mind. But even fixed income, you have to recognize net of inflation and tax. The returns are more like a treadmill. More you run there, more you remain at the place, and at times you walk behind if you or you may trip over if you don't do it carefully. So fixed income is still required in order to give you that robustness of mind to take care of your needs, to take care of your some amount of aspirational ideas, and to take care of some contingency. But having done that, that surplus capital thereafter has to find way into equity. But again, markets have no obligation to you. Markets have no duty towards you to make you rich. Market equity is the only asset where probably net of inflation and tax and the other cost, you can still aspire to have double-digit compounded returns. But again, it is not automated. It's not a God's benediction from the above. You have to earn it, you have to work hard, and you have to strive to get it. But if you do that, the rewards are fantastic. And last point I'll say, um, don't try to judge markets too much. Don't try to ponder over imponderables. Market investing is not about gambling. Investing is not about timing. Investing is not about technical gambits. It is not about macroeconomic punditry. It is not about geopolitics. It is not even about nice sounding chat of bright sounding trends and fashions and fades and all of that. Equity remains from 300 plus years of recorded history as it shows a very simple, dull, boring task of keeping your head down, finding a few qualitatively sound, good businesses, good managements, finding a discernible growth, quality of growth, convert into value, buy at a sensible price, and then have a vision to stay with it for as long as that equation is profitable and serving you well. That is what equity investing is all about. And therefore, as you yourselves correctly mentioned, you have to treat and keep a mind of watching the grass grow slowly. It is not a get rich quick scheme kind of an idea. If you want an excitement, casino is a place. If you want entertainment, then theater is a place which these days you can't even go to. If you want indulgence or a hobby, gardening may be a more appropriate thing to do. Equity investing is none of this. It's a serious task, and even if it is your money, you have to treat it with dignity, with respect, and as a trustee. You can't treat your own money with a sense of nonchalant, guilty kind of behavior.
Okay, thank you so much, Mr. Shah. Harish, you want to say something towards the end?
Yeah. See, I would like to read out what Mr. Warren Buffett gave as six advice in 2009. It's basically, he says earnings. The first is one is earnings. Never be dependent on one single source of income. Your investments has to be a second earning. So that's one. Second advice from him is spending. If you buy things you don't need, you will soon sell things what you need. Third advice is savings. Don't save what is left after spending, spend what is left after savings. Fourth, borrowings. The borrowers become the lender's slave. Fifth, risk taking. Never test the depth of the river with both the feet. And you need to have an alternative plan ready. And sixth is don't put all your eggs in one basket. So with this, Happy investing. Thanks for joining us.
Yeah, thank you so much, everyone, for your time. And thank you, Mr. Bharat Shah, for your insights and
Thank you, Lokesh.
time you gave us.
Thank you, sir.
Thank you so much.
Pleasure talking to you for all the pertinent and very, very wise questions that you were raising. Thank you.
Thank you so much, sir. Thank you. Thank you, everyone, for watching.